Welcome back to Squawk Box, everybody. We are here at Bank of America's New York trading floor this morning, and joining us right now is Bank of America's CEO Brian Moynihan. Brian, I want to thank you, first of all, for hosting us here today, and doing it on a day when there's a lot of market activity that's coming. I didn't realize until I got here this morning that this is actually 15 years since last night. Since you were named CEO. You took over in January of 2010, but you were named just last night 15 years ago. What a long, strange trip it's been, huh?
Well, no, it's been great. It's been an honor to lead this great company and all these talented teammates out here. And it was 15 years ago yesterday that the board met and announced it, and we announced it. And then I had my first town hall with everybody today, 15 years ago. And you know, it's been great to see this company take its position as a leader in all its businesses with great scores from those customers, great scores from the teammates, delivering for shareholders, helping what you can do to help society. It's a great company. It's an honor to lead it, and I'm very proud of what we accomplished.
Yeah, the stock price has more than tripled over the time that you've been here. And I know this year's been a good year, too, up 34%, I think, year to date, maybe 36% over the 1 year. There's been a lot of enthusiasm very recently about financial stocks in general, just given what we're seeing with a new administration that is poised to take over. Why don't we start talking a little bit about that? I heard you say in the last week or so that you thought it was very rational to see these stock prices taking off like this. You want to explain?
Well, that's part of the thesis that the banking industry's valuation relative to the other valuations you all spend all the time talking about is still lower than usual. But yeah, in the end of the day, we had a swing in regulation that probably went too far, and that there's hope that I'll come back. For the smaller banks, the ability to merge together was slowed down, and as an investment banking firm, you know, we can't buy anybody because it's not legal under the rules, hasn't been for 30 years, but as an investment banking firm, we like that activity. And then, you know, and the belief is the economy is going to grow, and that the belief in the economy growing, well, the markets are up and all the activity, and I know you've got Jimmy DeMar, my teammate, on later to talk about what's going on in the actual markets. But yeah, the activity among our customer base and stuff, the enthusiasm for potential deals for non-banking clients getting through and happening, you know, there's a lot of enthusiasm. So it'd be completely irrational if the bank stocks would follow the economy and the optimisms come out.
What did you hear? Do you tie this back to the election with the regulatory oversight that's coming, or the changes in the regulatory oversight that are coming?
Well, the President-elect Trump ran on a position that there was too much regulation and too much had to be dealt with, obviously, inflation, immigration, regulation. And, you know, that obviously, for people who've been in this industry for a long time like myself, we got to get the thing back to the middle, and he's been clear about that. And I think the appointments he's had so far, which is really Treasury Secretary, they haven't gotten to the bank level appointments, are clear that they're going to try to maintain stability in the operations of the Fed on the monetary side, but push hard on the regulatory side to get the balance back in the system.
Scott Bessent is the choice, the incoming president's choice for Treasury Secretary. Have you spoken with him at all?
I've spoken to him. I know him. He's terrific, and he'll be great. And he knows our industry. He knows what goes on these desks. He knows what goes on. But, you know, at the end of the day, one of his challenges is he's got a big budget deficit, and we've got to get that more, our eyes and stomach aligned, right? We're running a $1.8 trillion deficit last fiscal year. Mm-hmm. That's equal to the entire GDP of Australia, to give you a sense of size. $30 trillion in debt and growing. So we've got to get that aligned, and he's going to have to be a leader in figuring out the balance of all the ideas to see how they all work.
I mean, it's a tricky task, especially when you listen to everything that incoming President Trump has had to say about things. On the regulatory, obviously, that's going to be great for growth, big deal for a lot of businesses who are here. But there have been a lot of fears and concerns about tariffs, for example. What happens with some of those talks? What happens with trade? How do you balance it all out? I've seen what the bank has said, but what do you think?
Well, I think Candace's team has taken the position that if you really see the regulatory relief and other activities increase the profit margins of companies and the tariffs come through, they will eat more of it. So the effect of the inflationary side of the tariff will be lower because the companies will be willing to eat it because they're making more money, and they never want to change price. It's a very competitive market out there. You raise price for whatever reason, even with pass-through goods prices, you know, people seek alternatives. So I think people feel it's relatively balanced in the range of tariffs that are being talked about. At the end of the day, you know, I think this discussion went on during President Trump's first administration. It will go on again. It's already started up in advance of even the inauguration. And it's about a fairness. You know, we buy a lot of stuff from other people. We have the largest consumer economy in the world. We have the largest economy in the world, so we buy a lot of stuff from other people. Why aren't they buying our stuff? Mm-hmm. And the reality is they're trying to get balance to that. And that creates jobs and more opportunities for American companies. So it's hard to argue with that. But the question, it has to be balanced against the impact on inflation, the impact on slowing down the economy, and also what what we realistically can do in this country. There's things that are made in other countries that have been made there for many years that are so inexpensive, the American consumer, you have to think hard about whether you actually can bring in this country and create the kind of jobs that you want to create.
It sounds like, I think the bank's official policy has been that it's going to be a wash between the two sides on this. It sounds like you are a little more positive about things, though.
Well, I'm more positive than enthusiasm. America, if you think about what was coming through last summer, you saw every time our teammates put out their economic projections of consequence, and they really changed them. It was always increasing the GDP growth rate for this quarter and into the early part of next year. So in fact, you've gone from where, if you and I were sitting here last year, we'd have said this year is probably like 1% plus this quarter. Now we're at 2% plus. Next quarter we're at 2% plus. That was only a few months ago was 1.5%. So they keep increasing that. That was building all the time because consumer spending was solid, employment levels were solid, companies were making money, companies were investing. But as you came through the summer, then you had the kick of, well, maybe there's more ahead. And so now those economic projections are literally gone up by almost half a point. That's what's leading to more optimism rather than whether the tariffs will cause a little bit of inflation or not. If the economy is growing, everything is a lot easier.
You made some comments very recently, I think in the last week, maybe at the Goldman Sachs conference, where you said you're expecting for the fourth quarter 25% rise in investment banking fees, about a 20% increase in wealth management fees, and record trading level revenues. Those numbers, again, how much of that is tied to the growth that you're talking about? How much of that is tied to either consumer confidence or company confidence that has built post-election?
I'd say it was tied to the trends coming in, and now those trends are expected to continue more strongly, right? So that's creating some things. You don't have investment banking fee booked for an M&A transaction this quarter that wasn't already signed up.
Sure.
Just because of the time frame. So I'd say if you look across the businesses and Matthew Coder and team, what they're seeing is what we're sort of pro forma conversations. People would have you in the summer and they'd say, we got to take this company public of a financial sponsor. We got to get this company out when the window opens and when valuation is right. A strategic buyer would say, hey, look at those companies. Yeah, that looks interesting. We want to buy those companies. But it was more pro forma. The pitch was, here's a bunch of ideas. Oh, yeah, it's great. Let's talk later. Now it's like, get in here now.
Is this later?
Yeah, this is later. It's get in here now. We're going to try to hit the windows. We're going to try to sign this deal up. We're going to move. That's really bookings for next year, honestly. But what's coming off this year is just that stronger economy coming through from the summer into the fall.
So what do you expect come January?
I expect you'll see I expect you're seeing more deals signed up now, and you'll see more deals. Even since just in the banking field, you've seen like 3 or 4 deals announced recently. And I think the pace will pick up because the biggest issue, and I know you had Amy on it earlier, the biggest issue for a board when someone's making a proposal to buy you is what's the certainty of getting it done? The price is there. It's obvious. The question is, what's the certainty? And then what's the duration of that and how destabilizing it is to the company that's selling prior to getting it done? If it's a year's process and it should be a 3-month process, that's tough. If everything gets looked at 2 or 3 extra times, and not everybody has the staying power to sit on a deal for 2 years, it's hard. So that certainly then moves people ahead. If you look at the markets, it was more the market rose based on all the enthusiasm and all the things that you've talked about every day, and so the activity of volatility kicks up. And if you look at the consumer, though, the consumer is more fundamental. It's what's happened is in the middle of summer, I think when we were talking various things, the consumer had slowed down. And I was getting concerned that the Fed was going to get behind a bit on cutting rates. As soon as they said they were going to cutting rates, you saw consumer enthusiasm pick up a little bit. You saw a little more activity because they realized in the future the rates are coming down. And that started happening, in the September timeframe. And so you started the spending picking back up. And right now, for the 2 weeks around Thanksgiving, it's 5% plus of all kinds of spending over last year. And that's stronger than it would have been last year, the year prior to that. So that means the consumer's in the game. Now, interesting enough, more on cosmetics and clothes and less on real luxury goods, more on experiences and travel and things like that, which is all good. That means the breadth of the economy is strong. The only segment that's still, fighting to get along is because the higher rate structure is sort of the housing and housing-related projects. And so I'm speaking to...
But is that the higher rate structure, or is that the supply that's out there at the time?
The supply of housing is one question, but even the higher rate structure, even on the home equity lines, our home equity lines are still 30% below they were pre-pandemic. The person has the right to borrow. The rates are relatively inexpensive. The facility's all set up, so if you wanted to put a new bathroom, it's just that they're saying, these rates are high enough. I ought to think hard about this. That'll change over time just because people get used the roads and the wage growth has caught up to the rate structure. We don't expect the medium-term rate structure to move down a lot. We expect to sort of sit around this level, which is more normal. We expect the front end to come down, and as the consumer just gets more used to that and the wage growth and stuff catches up, you'll see that be activated.
So if you were worried around the summertime that the Fed was maybe behind the curve in terms of cutting, what do you think now? We've had a lot of people questioning whether they should be cutting rates at this point.
I think they've got to get to, I think our team thinks they're going to cut today. You had Michael on, I think, earlier, and then a couple of times next year. But think about what they're really saying is the end state of the Fed funds rate will be in the 3.5% to 4% range, not in the 2.5% to 3% range. That was a big change over the last 6 to 9 months. That's because inflation still doesn't get down to sort of lower twos they have until 26. So with that length of time, they've got to stay higher than they'd otherwise be. It's a real rate structure. It's very restrictive on small, medium-sized businesses because that's who they were borrowing at 300 basis points over 50 base, SOFR at 50. Now then they went to 300 basis points over 5.5. Now they're back down to 475. That's still a lot more interest costs. They've slowed down, quit using the lines as much. The activity year over year is okay. It would be a lot stronger as rates come down because then it's just cheaper to borrow. And that's where the real restriction, the real rate structure is there. So they have to come down a little bit to get more normalcy in the system.
Brian, 15 years ago when you came in, you inherited a bit of a mess stepping into this place. You spent the first year trying to make sure that the bank had enough capital on hand, because we're talking back at 2010, just after the financial crisis hit. Part of what you did was take $5 billion in cash from Warren Buffett. He has a huge position in the bank. He's been the largest shareholder for quite a while, but we did see in the third quarter that he's been cutting his stake in the company. I think he sold something like 200 million shares. He still, the last we've seen on the public filings, had 9.99% stake in the company, still a major holder. Do you know why he's selling, and have you spoken with him about it?
I have not, and that wouldn't be sort of right. But there's been a lot of speculation. You can ask him. That's your job. But look, at the end of the day, he made two investments in the company. That was a little hard for people to understand. He made one in 2011, and for the first time, he told me that for the first time he's ever done it, he made another major investment in 18 and 19, and that's a higher basis, so he sold that down. But he came to us in 2011 and called me up, and you've reported on it and said, I want to put $5 billion in a company. And I said, we don't need it. And he said, I know you don't. That's why I want to do it. I want to stabilize a company. From that day, if you would invest in our common stock at 5 and change it was that day, you'd be up as much or more than he is, frankly, in terms of economic value. He did it. It stabilized the company. At that point, we had 260,000 people, whatever it was. They all came back to work, said the best investor put the money behind. That endorsement allowed us to keep just driving the company forward, and the rest is history. So he's done very well. He's been a great shareholder, and at the end of the day, he owns a lot of investment in this company, and we have to keep producing for him.
Yeah, I think it's still around $35 billion that the stake is in this company. When you started in 2010, I think Bank of America had a cost structure that was in the high 60s, maybe?
70, yeah.
It was 70.
72, actually.
Okay, so 72. Where is the cost structure today? And I'm thinking of this from the perspective of hearing what DOGE is planning on doing with the federal government. Elon Musk and Vivek Ramaswamy really want to make sure that they're more efficient and effective with the U.S. government. You've got some experience with this. What would you tell them?
Yeah, so we had 285,000 people the day I took. We went up to 305,000 people, and now we have about 213,400 as of last week. And so that is all made possible by digitization, efficiency, eliminating work. And when you do that, it sticks to the ribs. So this year we'll end up with expenses $66, $67 billion, whatever.
Which is below when you took over.
It's below where it was in 16.
Below where it was in 16,
nominal.
with inflationary pressures. Yeah.
Nominal. And by the way,
far more profit that you all kicked
our
off.
compensation expenses are almost 30% higher than they were pre-pandemic in the total. And so
where'd the cost come from?
It's all compensation.
Yeah.
We're 70% compensation. So in the end of the day, it's all these talented teammates getting paid more for more activity and more active. But the way you did that was eliminate work. And that's the key, is to make it stick to the ribs, as we call it. You have to eliminate work. And we constantly engineer the company, take 1% to 2% of the work out, the heads out, and then replace it with 3% to 4% spending and inflationary growth. And that grows net 2 now, and that's what we're shooting for. It's the adjustment out of the pandemic obviously took a while to settle in. We're starting to settle in. But my advice to them is eliminate work. There's a lot of things that people say, this is waste and that's waste. Those are obvious. But if you don't eliminate the work and automate the work and digitize the work or get rid of the work because it's duplicative, it's not going to stick to the ribs. It'll just creep back in. And then, so that's what we learned. So think about it, 280,000 people, 285,000 people. 213,000 people. This company's consumer base is twice as big since then. The customer experience scores went from 60 up to the 90s. Its teammate scores went from the 60s up to the 85, 86. So you have happier teammates and happier customers, and you've been able to reduce the headcount that much, and that's through all digitization. The customer's behaviors change, but you got to eliminate the work. You can't just wish it away.
There was a report in the New York Times this past week. I want to ask you about it. They saw a congressional memo that suggested that they were looking into SARS reports, two SARS reports, suspicious activity reports, that the bank made for transactions from Leon Black to Jeffrey Epstein. The report suggests that those came much later. They were after Jeffrey Epstein killed himself, and not in the same timely manner. Why did the SARS reports come later?
At the end of the day, believe me, we comply with the law and do everything, and it's been out there, and we're examined heavily on this. I'm not sure all the facts that came out, all that were right, but you should rest assured that we have a lot of people looking at everything we do in BSA and AMO all the time.
Okay. Last year, you came back into a position at Brown University and took over as chancellor at your alma mater. People kind of speculated at the time, that's a big job. There's a lot to do. What are you thinking about your job here, 15 years in? What are your plans?
Well, just to be clear, the chancellor's the chair of the board. It's not a job. Chris Paxson, the president of Brown, has been the president. I think this is her 13th year. She's terrific. She runs the place. Our job is to be the chair of the board of directors. So I dropped other chairmanships and chairpersonships I had in other nonprofits, NGOs, trade groups to make room for it. And so Chris does a great job. So my job is the 53 board members. I've been on the board since 2010. But at the end of the day, I went there. My wife went there. Two of my kids went there. Their spouses went there. My brother went there. His spouse went there. I owe that university a lot. That's why I'm sitting here today. And so my job is just to help that board govern the place. I've told the board I will stay here as long as they need me to stay here. I have great enthusiasm and the great prospects this company has. It is amazing what these teammates do for the customers every day, whether the consumers, wealthy consumers, small, medium-sized business, the biggest trading, investing firms in the world, the biggest companies in the world. And you watch that go on. It is just unbelievable. And every day I get up and see some of that go on and see what happens, get a note from a customer. It just shows you what a great company this is. And so with that enthusiasm, I can go as long as they want me to go, but it's up to them.
What do you think of markets next year? What's your expectation?
Well, you've had our teammates on. They expect the markets to keep increasing, but we had a big bump now. So I think 6,000 the S&P. Everybody's talking about 6,800 next year. If you went back and said what happened 3 months ago, they would have been a little different. So I think we got to be careful about getting ahead of ourselves. But it's very constructive right now. Earnings are growing, and that's what Candace always reminds all of us about: is if earnings are growing, the market ought to grow.
Okay. Yeah. Brian Moynihan, I want to thank you, first of all, for joining us, and second of all, hosting us on the floor here at Bank of America today. We really appreciate it.
Happy holidays, Dave.
Thank you. Happy holidays to you. Squawk Box will be right back.